Hey everyone, welcome. It's Ryan Keenan, and I am back as advertised with Padi Goodspeed of Cross Country Mortgage. And Padi is so gracious and kind of her to be able to spend time with us today every Thursday. This is the first one we're doing, but she is going to answer questions about the economy, what is going on, and everything you need to know to make you money in this economy. And first, I'd like to introduce Padi. Welcome, Padi. Thanks for joining us.
Thank you so much. I appreciate you having me, and of course, the challenge of having to speak on these tough topics from
Yeah,
our perspective in the real estate world by keeping in mind what people really need to know, not just the buzzwords.
that's right. And just so people know, I know we've gone over it before, but just to recap kind of how your year is going and just your credentials quickly, just so people have a better understanding of who you are and what you do.
Sure. So I've been a mortgage banker for 20 years, really decided to step things up over the last 7. I have funded over my career $1 billion worth of residential loans. It's an important distinction because the volume, loan amounts are much smaller in the residential space. Last year, I funded over 183 million. A majority of my business was purchase business, and this year I'm on pace to close out with 100 million, despite the downturn. And I'd like to call it a screeching halt in October. We're all feeling that, but definitely have been able to stay consistent in our flow of applications and closings, which is sincerely just a testament to my resilience and to the experience and to my tenure in the business. I didn't even realize I knew how to talk about these topics actually until the pandemic, when I started speaking a lot on Clubhouse. And then, of course, throughout this financial crisis or meltdown or downturn, where so many people are asking for my insight. So I'm grateful again for the challenge, but definitely have spent 2 decades in this business, and I've seen a few things.
Yeah, I'm sure. Definitely. That's a really long time. And congratulations on the incredible year and all the accomplishments that you have going for you this year and throughout your career. And we are so lucky to have you here today to talk about these topics. So let's dive into it. CPI came out this morning. It was a little bit hotter than expected as far as inflation goes. So what is important about the CPI, and when does that come out so people can know to look for it ahead of time, and what impact does that have on inflation?
Yeah, so we're measuring it month by month. And right now, what you're going to see is that actually the year over year inflation number went down. So we went from 8.3 to 8.2. But the expectation that was set was that it was going to go down to 8.1. So the shift did
Hmm.
not meet expectations, and the month over month went up by 0.2%. So that's where, see, any shift, anything that doesn't, any minor deficit where the expectation is versus where the number comes in is what they don't want to see. So we need to see that there's obviously, these are very small variations. So for example, if the expectation was that the CPI report came in at 8.1 and it came in at like 8%, then you would have seen a huge rally today and interest rates drop, and all the headlines say now the 30-year fix went from 7.25 to 6.99, and that's what you would have heard. But you didn't, because it did not hit the expectation of 8.1. It landed at 8.2, but it still went down by 0.1%. And there was a slight increase from last month. We knew that that was going to happen. So there's a lag in these reports. So what it means is that this is how the cost of buying goods and how we're spending money and all on how those it's called a consumer price index. So it measures how the prices are changing, and the prices change based on how much people are willing to spend money. Again, 70% of the economy is made up of us, the people, spending money. So when these numbers aren't changing, so it's telling you, hey, people are still spending money and prices are still going up. Because one of the examples we've talked about before is that whenever you have a price of a good that has gone up, less people want to spend money, right?
Mhm,
So
mhm.
we're not seeing that shift happen fast enough. And so the Fed standpoint has to remain what they call hawkish, which in our world means aggressive. So they're saying, hey, if you hear the word hawkish, the Fed remains hawkish. That means that the Fed is standing over this world, looking at us and saying, we've got to stay hard, we've got to stay aggressive, and we have to continue to hike rates. because hiking the Fed funds rate means tightening the money supply, raising prices to balance demand and supply so that we can create price stabilization. That tune hasn't changed since the beginning. And they are criticized constantly for this aggressive, hawkish outlook and their standpoint because it's hurting various parts of the economy, as many people will see in their stock portfolios, right? Because
Right.
when you have news, I often use the example about stock prices going up and down and how much people don't understand the psychological impact of news, just the psychology of things, why the news matters. If you watch Billions, you would know, right? So it's like, remember when Elon Musk was on Twitter talking about smoking weed and Tesla's stock took a dive? It was because if the general public doesn't have confidence in Elon Musk's ability to run a company because he's frivolously smoking weed to sound cool on the internet, then people are going to say, wait a minute, I better move my money. People will sell stock. And as a result of that, for that day or for a time period, the price will go down.
Mm-hmm.
So you have a very similar dynamic that's happening with mortgage-backed securities in the bond markets. So when you hear the news that the Fed is going to remain hawkish, they're going to stay aggressive, and they're going to continue to hike interest rates, then what that indicates to the market is that things are not getting any better. So then people want to create liquidity. So when you hear the term, I want to create liquidity, that means, let's say, Ryan, you and I bought 7 Bitcoins, right?
Mm-hmm.
We have 7 Bitcoin. Now, you know what? Shit, I might not have commission for 2 months. I better go sell one of those bad boys because I can still get 20 grand for it. That's creating liquidity. So when you hear about like the Europeans wanting the Bank of England, excuse me, wanting to sell bonds and what does that mean? Or they want to buy bonds, is that they want to create liquidity in the markets. When the government buys bonds, they're putting money back into the bank, creating a more liquid situation that helps enhance the flow of money, which drives the prices up. So we don't want, so the Fed is saying we're not going to keep doing that. We've got to tighten things up, and we need to make sure we're not as liquid. So that's what it means. And the CPI report is, all eyes should be on the CPI report on a monthly basis. The PPI report also came out. That's more of the wholesale prices. It's in our world, we say no one really respects that number. It didn't move the needle at all. Doesn't have a huge impact on inflation. And to simplify this for everybody, people are looking for all kind of indicators to see when mortgage rates are going down. That's what most realtors care about, right? I've been doing this for 20 years, and a lot of realtors do not invest time into understanding what the market actually means. It's usually just hot and cold with sales. So it's really wonderful that you do take the time to understand this. But B, to really note that most people really just want to know, when are interest rates going down? What's going on? And if there's one thing to focus on, it's that CPI report, because when you see the inflation number starts to come down, then you're going to know that the Fed can now take their foot off the gas of this hawkish/aggressive rate hike strategy.
Okay. So with that being said, where do you think let's just we'll cut that. We'll just keep going in order. Sorry, hold on. The phone's ringing. Okay, so speaking of the Fed taking their foot off the gas, obviously they're full speed ahead on their approach. We don't see much change coming anytime soon. That's for sure. They're going to stay hawkish, and they're going to continue to raise the funds rate and try to, I used the word earlier, vacuum out all of the money that's heating up the economy and try to slow things down, as you said, coming to a screeching halt. But is there a benefit to owning an asset during an inflationary market right now? Is that a good thing?
So owning assets in an inflationary market, in a broad way to answer that question. So in an inflationary market, should you own a house? Let's examine what that meant between 2019 and 2022. It meant that you experienced approximately 20% equity gains in a short amount of time. Okay. So anytime, as a professional, as an investor, and just simply as a homeowner, if you see the market heat up to the point where you've gained 20% equity in a 2 to 3 year time span, then you're experiencing what happens in an inflationary market. So let's say what's good and what's bad about that. That means,
Okay.
well, what's good about that is that the Chanel bag that I bought for $6,000 is now worth $9,000 and no one can get it because it's not being manufactured anymore. And I can sleep at night knowing that I had made a good purchase, even though it was completely impulsive, right? So absolutely fabulous to buy assets in an inflationary market because my Chanel bag just made me $3,000. My grandkids will be happy. Okay.
Mm-hmm.
So you can apply that to anything. You can apply that to anything that you're purchasing. The flip side of that is that the average American who's not seeing a growth in their income is spending anywhere between $460 to $700 a month on the three main categories: food, housing, and energy. Okay, so energy being gas, transportation, food, energy, and transportation, I should say. So the problem with the inflationary period is that prices of goods and services are going up and your assets are increasing in value. However, the problem is if your income is not growing at the same rate of inflation, you have a serious problem. So that's the important thing that people need to understand when we're putting it in simple terms. Let's say Ryan, you and I are married and we want to get we are, let's say, our mid 30s, and we want to retire when we're 65 or 70 years old. Let's say our lifespans are a little bit better. We can work till 72. We'll be fine, right? So when we turn 72, let's say we're 32 now and we're going to turn 72 and retire. So we have 40 years of work before we want to, kick the can. So if that's the case, you and I decided today that we need to make $150,000 a year in retirement in order to live the lifestyle that we want.
Mm-hmm.
Well, the truth is that when we retire at 72, 150 grand won't cut it if inflation continues to grow and grow and grow and grow over time.
Right.
That's why it's extremely important for government intervention. There are lots of schools of thoughts in economics, and many of them would like that we don't have a free market system. It doesn't exist. A free market system would mean that really, truly, supply and demand would constantly be the governing factor of price. We just don't have that. There's going to constantly be market manipulation, and it's strategic and it's done by the government to make sure that there's checks and balances and that we create some sort of balance when necessary. So in an inflationary market, if you were purchasing a piece of property and your house went up by 20%, and in a recession, if you lose 10% of that, is it detrimental? Is it something that you should lose sleep about overnight, especially with a 2.875% interest rate on a 30-year fix or a 7/1 ARM? Not so much. So it's always important for me as an individual, as a professional. What I tell people is the best time to buy real estate is when you're buying within your means, period. You're always making the investment for a long term, not the short term. So whether it's an inflationary period, someone would come back and argue and say it's way better to buy during a recession because you want to buy low and sell high. There's an argument for every stage of our economy.
Hold on.
Buy when you're buying within your means, and you're not making that decision based on an emotion such as FOMO that many of us had during COVID when we were sitting in our rooms, bored as shit, wanting to remodel our bathrooms and thinking, what are we going to do here? Everyone was at Home Depot. Everyone had something to remodel and everyone wanted to buy a house. And that's all you saw online. And it just drove this demand and everybody wanted to buy a house. So as long as you're not caught up in the emotions and you're buying within your means, it's always a good time to look at real estate as a primary investment strategy.
Awesome. Good. So speaking of real estate, we are in an inventory shortage. It's no secret, especially here, what we're seeing in Monterey County. We are not seeing a lot of houses going on the market. I think we are under month every year, or every month we are seeing declining inventory. And with a decline in mortgage applications, I think I read somewhere it dropped by like 25% or more. And I can't remember if that's year over year or month over month. And maybe you can help us to figure that out. But what is year over year?
No, it's 29%. Yes, year over year, 29%.
Okay. So yeah, with the shortage in mortgage rates, applications, and the lack of inventory, a lot of buyers are sitting it out. So what programs do you recommend buyers can take advantage of now that will help them in the long run, as you
Okay.
say, not in
So
the short term.
in the short, let's do short and long term.
Okay.
So here's the thing. 3,000 real mortgage and real estate professionals were surveyed. 71% of them said that they were experiencing some sort of reduction in price. Okay. But there was a really interesting note made in this article that if you have 71% of the community experiencing some sort of shift in pricing and reduction of pricing, let me ask this question to our viewers. Are you seeing that the value is going down? Are you seeing that you have a more realistic list price? We saw people just kind of adjusting the list price because the demand is gone. Here's why this distinction is important. Before we got to this point, I kept telling people we're not seeing the price, the value go down. We're seeing the person that was in the market who was willing to write $100,000 check as a premium to take you out of the game, to compete against you and take you as a buyer out of the game because that's how bad they wanted the property. That element is gone.
Right.
So we're not seeing, and what you're highlighting in regards to inventory is exactly why the word crash should not be used in any statement related to real estate, period. You can't have a real estate crash without having an abundance of inventory. If you go back to 2007 and 8 and you compare the inventory figures to what we're seeing today, there is a drastic difference. So the word crash should not be coming into anyone's vocabulary when describing real estate. This is a contraction. This is a correction. This is the normalization. This is the stabilization of price. Okay. So if you have a buyer that's sitting on the sidelines, or you are a buyer that's sitting on the sidelines, here's the thing. Many of you were sitting on the sidelines when those premium checks were being written because you couldn't compete. Many of you guys were complaining that people were buying with all cash and you couldn't compete. Now you're complaining that the interest rates are up and you can't afford the house. So sometimes people are on the sidelines because they're afraid of jumping into the game and facing some of the fears that they have to become homeowners. It's a big responsibility. I have to tell you, I've experienced a lot of times clients have been actually afraid to take that step, even though they had stable income, good savings, and good credit. So I like to always address that because it's a real factor. So one of the primary benefits of home ownership is simply the act of going through the process and accomplishing that goal. When you do that, just like many other goals you've set for yourself and achieved, you realize that nothing is impossible. So home ownership is extremely important. It's one of the only ways that many of us have to build any sort of generational wealth. So let's get that part out of the way. So if you're a buyer and you've been on the sidelines, but you've been on the sidelines for quite some time, I think you need to address the fears that you have about the commitment necessary to become a homeowner. The market is always going to go up and down. Nobody can time the market. But I can tell you that over the last 9 recessions that we've had in the United States, if you observe housing, you will see the price has done nothing but increased over time. So owning a home is a smart thing. If you compare ownership to renting, although you will see in reports that come out that for the first time in many years, I forgot the number of years, but for the first time in many years, we're actually seeing the demand for rentals come down. People are staying put where they're at, and you might see some rent prices leveling a little bit. So if you're a landlord or you're an investor and you're betting on rent prices going up in 2023, you're making the wrong bet. They need to remain stable. Rent's not going to go up in 2023 the way we've seen it go up in the past several years. Although it will eventually, start going back up again because of inventory, but you won't see rents rising in 2023. So if you're betting on that, that's the wrong bet. Things need to stabilize. Okay, so programs for first-time home buyers exist across the board. And many times people will look for solutions to buy a home with zero money down. You will almost never hear me talk about down payment assistance because I didn't think in a peak market buying a house with 100% financing was smart. And I definitely don't think in a market where we can potentially see anywhere between 5 to 15% in price shifts in 2023, it would be a good time to get into a loan with 100% financing. Here's why. If you take a loan and you have a loan for this, you have a second and a third loan in place to cover your down payment and closing costs, they've changed the rules on those programs such that when you go to refinance, you can't just refinance to lower the interest rate on the first without paying off the second and the third. And the likelihood of you building the necessary equity over the next 3 years to cover that balance is not high. So if you're thinking about taking a down payment assistance loan and you want to refinance, and your lender's telling you can just refinance and lower the interest rate next year, it's not true, because you can't refinance without paying off that debt. So if you understand that and you still want to engage in a down payment assistance program, they are available to you. But please make sure that the lender you're working with, hopefully it's me, is going to be extremely transparent with you about how it works. That's one of my pet peeves. I want people to understand the cost of acquisition of the asset. So in 5-6 years, you never wake up in the middle of the night thinking, why didn't Patty tell me that? That's really important to me. Okay, so there's another program in the Equity Builder Loan Program, which gives you 10% of the purchase price, and it's forgivable after 5 years as long as you're at home as a primary residence. I like this product because it's not giving you multiple loans, and it's 100% forgivable. That's the Equity Builders Loan, 10% of the purchase price. One of the challenges that we face in California with this product is that the income limits are super low. You have to be below the average median income, and a lot of households simply are not. And you can still be above that number and have a hard time affording housing, but that number really needs to change. So that program is sincerely designed for those that really need it. But when you have 10% down and you have a seller that's willing to cover closing costs, you can't do a rate buy down on those programs either. So it really puts you in a nice position to lower that payment. So I would advise people, if they're looking for down payment assistance, first start with the Equity Builder loan. Then we also have a really cool cash buy program. So Ryan, let's say that there's two programs. So you have a cash buy program and a bridge loan. I'll run through them briefly and we can move on. So the cash program is if your client comes and says, hey, I want to compete for this house. And believe it or not, just like Ryan said, and I love those posts with the numbers that you made on your Instagram stories for the numbers in Monterey County. You have properties that are nice, that are well kept, that are staged properly. They're not lasting on the market that long. If you look at the numbers, you're going to see the homes that are sitting on the market longer, they're not up to par. They need work. They don't look great. The ones that look great, they're getting snatched up pretty fast. So if you have a property that looks nice and you know there's going to be competition and you know that financing won't cut it, you can either do a fast track approval and an offer with no contingencies and a 15-day close of escrow, or you can offer cash. You can use our money to buy the property cash. You still have to go through the same loan approval process because we're going to turn around and conduct the purchase transaction afterwards with a standard loan, but it gives you the edge with the competition. Here's why I say that matters. So from all of the reports I've read about the projections of home prices going down next year, they've averaged between 5 and 15%. Okay. So if you were able to negotiate for me an 8% discount or a massive seller credit towards my closing costs, and I've saved money ultimately on my acquisition price, well, you're helping me hedge against the 2023 recession that's going to create a price drop. So if prices are going to drop, but you got me a discount up front, I'm in pretty good shape here. So how much do you think a cash offer is going to help that negotiation? Pretty significantly. Okay. Then we also have people that have a lot of equity in their homes. So if you have a lot of equity in your home, but you need to sell first, and you know it might take you 2 months to sell at this point, because you got to get out of the house, you got to clean it up, you got to stage it, and you got to make it look good if you really want to get that top dollar for it, right? So a bridge loan is awesome, because if you have enough equity, you can qualify for a bridge loan up to 85% of the current equity that you have. You can use that money to pay off your car loan, pay off your credit card bills, put the down payment on the new house, and pay your closing costs for the new house. If you do that, your debt ratios are likely to qualify. You're lifting the financial burden. You move into the house, and then you go aggressively preparing the other home to get ready for the market and sell. So these are some of the programs right now. They're getting a lot of traction during this time because people need to be strategic to make those offers. People think back, remember 8-9 months ago, if you didn't have a non-contingent offer, the seller wasn't even going to brief on your offer. Okay. Now you're not doing it because it's necessary to be in the running. You're doing it because you want to show the seller you're serious and you want to get as much money back at closing as you can.
Yeah, absolutely. Yeah, just to piggyback on that super fast. I mean, I've highlighted this in my weekly update videos, but we're still seeing houses go for over asking, some multiple offer situations, and also under 10 days on market, which is insane in this kind of environment we're in, but it's not totally unheard of because of the low inventory expectations. So it's still competitive. So I'm really glad that you highlighted those things to let people know, hey, this is how you separate yourself a little bit more on the buyer side from, you know, what you would have done even 6-7 months ago. This is now a step above, you know, and this is the first time, honestly, that I've heard this. So I'm really grateful to, you know, to you, Patty, for sharing this, because I think
I'm
everybody
trying to do a
needs
better
to
job
know
of being
this.
a marketer.
What's that?
I'm trying to do a better job of being a marketer.
Well, you're doing great. So let's move on. Let's talk about to shift gears really fast. Obviously, we have a hike coming up with the Fed funds rate in November, which is going to be 0.75. And I've heard now that we're probably going to have another one, most likely in December, you know, which could bring the Fed funds rate, which is really fun to say, like above 4%
Right.
possibly, and you know, could keep our mortgage rates high. But let's just peel back the layers really quick, and just let's talk about what the schedule is for the Fed rate hike, and what's on tap for the November Fed meeting. What are your projections?
Well, I don't think we're going to see a 75 basis point rate hike. I'm hoping to see 50.
Okay.
However, there I could be totally wrong. I mean, another 75 basis point rate hike is on the table. There has been, for the very first time over the last 30 days, some significant discussions from the people in high places that are
Mhm.
using the R word. The
Yeah.
recession word has entered the chat.
Yeah.
And so
Don't say it. Yeah.
they went to the Wikipedia and literally changed the definition of the recession to be
Yeah.
able to not use the word.
Right.
However, the word
Yeah.
has entered the chat. So
Yeah.
we are in recession territory, and I believe
Mhm.
Europe is already in a recession, and
Yeah.
we're talking global recession, right? So
Mm.
we have a serious problem on our hands, and we could potentially see that there would be a 70, instead of a 75 basis point rate hike, a 50 basis point rate hike. But you got to understand, the United States leads the world in the most aggressive set of rate hikes that we have ever seen. And
Mm.
their standpoint on this has to be aggressive, simply because many of us believe they waited too late, right? I
Mm.
mean, this is a
Yep.
problem that they
That's right.
created, right? So
Yeah.
they waited a
Yeah.
little too long to start
Yeah.
fixing it, and therefore they have to be very aggressive with it. So what I
Mm.
think is, we say in a short period of time, well, really, what really constitutes a short period of time? I think maybe for the first time in 10 years, we're seeing real estate slow down during the holidays, right? I mean,
Mm.
it's been a while that real estate volume has not been slow during the holidays. I can tell you, I would bet you $1,000 right now that I could prove to you that I've taken at least one or two calls every Christmas for the last 5 years. So people have been extremely active, and we're just not going to see that this winter, right? If you look at your own pipeline and the phone
Mhm.
calls that you're making, the amount of clients
Mhm.
you're showing homes to, and the amount of listing inquiries that you're getting. In October, you have had significantly less than any other time in 2022. I can bet that, because I can tell you that's the same for me. In
Mhm.
March, I had over $61 million worth of loan applications. In July, it was 32 million. And last month in September, it was closer to 20 million. That's a
Mhm.
huge shift in
Mhm.
demand. Okay.
Mhm.
So we're feeling it now, but they're still reporting numbers from a month ago. So
Right.
the next reports that come out in November are going to finally show that, wait a minute, inflation is coming down a little bit and it's delayed. And then we're going to see them take their foot off the gas. So
Right.
our expectation in the mortgage world, based on the conversations we have and the, viewpoints on the bond market, we've always said that we think interest rates will start dropping March of 2023.
Hmm.
And then you're going to see a lot of people refinancing, and then you're going to see a lot of people
Mhm.
pick up and say, I want to buy. And then when the demand picks up, sellers are going to say, I'm ready to sell. So I say, in terms of what we're expecting to have a slow October, a slow November, a slow December, and then you're going to start to see things pick back up once these reports that are lagged start indicating that inflation is in fact going down. And then we see the Fed take their foot off the gas a tad bit. One of
Hmm.
the areas that I'm a little bit worried about, I'm not as well versed on, but I am slightly concerned about the decision that OPEC made to cut oil
Hmm.
production by 2 million barrels a day. So if you
Mhm.
think about it, and they've been criticized a lot by our president for that
Yeah.
decision. So if you're trying to knock out 2 million barrels a day in production in the middle of what is a recession and in the middle of a time where inflation is a massive problem, then you have just increased the price of production, manufacturing, and transportation and just regular old people going to work
Mhm.
across the world.
Right.
In the middle of a crisis like this, and especially an energy crisis, I honestly don't know why that decision was made and how it's going to impact those reports that we're waiting to come out. So the United States has like an emergency reserve that they've kicked in for the next 30 days to keep prices of oil stable, which means
Mhm.
that in November, you might see the price of gas shoot up. That's a problem because if
Yeah.
the price of something goes up and that percentage is high, for example, gas goes up by 15%, but housing is down by 3%, that doesn't
Mhm.
help the inflation number at all.
Right.
So
Right.
that's the problem. We have to watch.
Yeah.
What we're watching for is to see if inflation is coming down. And once we see that coming down, the Fed's going to take their foot off the gas. And then we can see some relief in the interest rate economy for home buyers and sellers. Why does it matter for sellers? Because they want more demand before they decide to come
Right.
off the fence about selling.
That's right.
Yeah.
That's a really interesting point, and I've obviously been paying attention to those articles, and I've seen the criticism that the president's getting for that decision. But it's also really interesting, and it just raises an interesting point and just something to think about. This is not a political show, but I'm just wondering if that goes into the whole new kind of Green Deal, Build Back Better version 2 that he came out with. That it's really a push to get people to invest in solar. I mean, he's given them a tax credit of $7,500 if you buy an electric vehicle, and then you can get more tax credit if you buy an electric vehicle that's like a truck of a certain size. So, it's just it's really interesting, and I don't think those two are related, but I think it's a really interesting correlation for sure.
I think it is important. I think it would be naive not to think that there's political motivation behind every single decision made for the economy, especially on a
Yeah,
global scale. So I
yeah.
think that's a wise statement.
And I also think there's some impetus too of direction that Jerome Powell needs to go that's agreeable to the current administration for him to be able to stay where he's at in his job.
Job security, we're all looking for it.
Yeah, that's one wage price spiral I don't think we have to worry about. I think he's pretty secure in
Right.
his job. Yeah. So let's talk about the R word real quick, and then I don't want to take too much more of your time. You've been incredibly gracious. This is awesome information. I'm so glad we're doing this. But I'd love to talk a little bit about the recession. I know the CEO of Chase Bank came out and said we're going into global recession. And I mean, you kind of echoed those sentiments a little bit, and it's easy to understand because the United States, the dollar is so strong, and we are one of the top, like you said,
World leader.
world leader. I mean, it's really interesting actually. If people are watching this at this point in the video, I just want to shout out Ray Dalio because he has a fascinating YouTube video. It's a half hour long, and it's called The Changing Order, and it really breaks it down very beautifully. And there's a book too, but the YouTube video is outstanding.
I just started a book club with that book. I'm so glad you brought it up.
Yeah, that book's incredible. Ray Dalio is like one of my heroes, and the way how he breaks it down is just, I mean, he really deserves more credit for the work that he's doing. It's pretty outstanding.
Yeah.
And the research that he's figuring out. And it's super interesting. Just to paraphrase real quick, he says we're like at a curve, and the United States is here, like at the beginning of the curve going down. And then when you get to the bottom of the curve, that's when the empire changes and a new country takes over and their currency becomes the dominant currency. So it's really interesting, and there's wars and stuff in between, and he can fill in the gaps way better than I can, but that's the basic idea. But let's not to go too far into the weeds there on Ray Dalio, but I recommend everybody check that out. So what's up with the recession? Should we stop spending money and save? I mean, obviously that's the goal of the Federal Reserve. I I went to Vegas this week for a conference. I just flew in one day and flew back at night, but I'm definitely seeing more people. Airports are packed. People are spending money on travel. I just saw United ordered like 100 huge giant planes. So, like how are we in a recession if we're spending all this money?
How are we in a recession if there's many new jobs being created? So for
Right.
the first time, we saw a slight dip in the job creation in October when the reports came out at 10.1 million, down from 11 point something million. So
Mhm.
there's new jobs being created, but there's a little bit of change that's happening in those reports. To simplify it, people are staying in their current jobs a little bit longer. They're not out looking.
Mhm.
So basically, when you have a lot of certainty about jobs being open, income opportunities that are higher than what you might have, you might be looking for another job to go out and look. So less people are doing that right now. And
Mm.
you still have a lot of job openings, but you also saw a company like Intel come out and say that they're going to be laying off 1,000 people, right? So there
Mhm.
are. I saw the article and I read about it and I actually sent it out to the people that register for my webinar. That the head of J.P. Morgan Chase is calling a recession, and they're saying that it's bad. It's going to be bad, and it's a global recession. Well, what does that
Mhm.
mean? A bad global recession. So what does that mean for us? I often say, okay, so again, Ryan, if you and I were going to Whole Foods on Friday night or Saturday morning, or we're
Mhm.
going to make Sunday brunch, and typically we'd go and maybe instead of buying the Kerrygold butter, we might buy that French butter and spend an extra $2 on the butter. We might
Right.
buy a pack of flowers because we want to
Right.
just want the counter to look nice, right? We might
Right.
get the organic avocados and not the regular ones because they're $7 and they're not $4, right?
Right.
So we're spending money in a way that makes us happy, right? Because we
Mhm.
know that on Monday we get to go pick up a check from the office. It's a commission check.
Hmm.
How does your behavior change inside of Whole Foods on Sunday when you know that that check isn't going to be there Monday and it'll
Mhm.
probably arrive in 3 weeks? So that's a recession. That's the feeling of a recession. When you
Mm.
don't have the certainty that the money is flowing at the same rate, people are not buying and selling. So if you own a ice cream shop and your business has been booming because every family in your neighborhood has had the extra income to go out and buy the ice cream on Friday nights. And when we're talking about extra income, we're not talking about a bonus. We're talking about them not spending an extra $3 a gallon on gas or not spending an extra $15 for every $100 they're spending on groceries, right? So all of that chips away at people that have budgets. If you have someone that is, especially in your economy, where you have a lot of people depending on RSU income, restricted stock unit income, and they have their values of their stock going down, well, if
Mm.
you felt like your net worth on paper was 1.5 million, you shop differently than when that number goes down to 900. Even though you still got $900,000 in the bank, you just lost, in your eyes lost. You don't lose until you sell. That's for another day. But the value of your portfolio just went down by $600,000. So how do
Mhm.
you feel? You're not driving by the Mercedes dealership anymore, I'll tell you that much, right? You're not house shopping anymore, I'll tell you that much,
Right.
right? That's the recession. That's how it feels. And so, one of the things that's extremely important for those of us that have been through the 2007 and 8 recession, the housing crisis, and so on, we kind of were like, when things are hot, we knew this is not a style that lasts forever. And even for those of us that knew what it felt like, this uptick lasted so long that it was very easy to forget that there was going to be another side to this. So
Mm.
if this is the first recession that you're going through as an adult with responsibilities and income and a business, then you're going to feel it and it's going to hurt. And you're going to remember that for the rest of your life, you have to be more conservative with spending. And that's what us little people have to worry about, right? We don't have trust funds. We don't have rich parents. We don't have money falling out of the sky. We're earning our keep. We're out working every single day. And so as a result, you should always have a 6-month reserve, always. So that
Mm.
means that my house, my car, my food, my groceries, my laundry, my everything that I need to spend money on to keep my house over my head, I should have at least 6 months, which for some realtors is 2 paychecks, right? If
Mm.
they haven't increased their life expenses so much. Many people will advise you that no matter how much your income grows, you're not supposed to raise your expenses relative to the increase in your income. You're supposed to keep
Right.
your expenses level as your income
Right.
grows. So these are
Right.
some fundamental things that we've learned over time, and not all of us adhere to them. I already mentioned the Chanel bag I bought. You're going to do things that are stupid no matter what, and no matter how smart you are, you're going to do stupid and impulsive things. I'm an excellent example of that. Um, so we just gotta, but you do want to be conservative going into the holidays, especially. And we've said this even when the economy was booming. Don't go into debt
Mhm.
for the holidays.
Right.
Don't spend money where you don't have to. Don't buy the extra avocado. Buy the one and buy it organic, but just don't buy two. You don't got to make
Mhm.
guacamole. Just chop a piece for your sandwich, right? So there are little things you're going to do to be a
Yeah.
little bit more conservative. And actually, what'll happen is if you continue that practice, even when things get better and the money
Right.
starts flowing again, it's even
Right.
better for the long haul for all of us and for our children.
That's right.
But I hope that no one thinks that I'm saying that as though it's easy. It's not easy, especially
Right.
for high income earners. It's
Right.
very easy to have a bias to think that when it's good, it's always going to be good. And I have
Right.
learned those lessons painfully. So,
Yeah. Well, really quickly, you said so much, but I just have just one follow-up question,
yeah.
and I know we didn't preface this, but I'm just wondering about credit because credit during a recession. I mean, I try to pay off my credit every single time I buy something. I try to pay it off immediately. So just briefly talk about what you should do with credit during a recession, if we are in fact in a recession right now, during this economy, how should your credit be? What can you do to, help with your credit?
Okay.
Not buy Chanel bag.
So don't buy it on credit. So,
Yeah, exactly.
okay. So I am never going to stand in between a woman and her Chanel bag. It's an appreciating asset. Sisters, go for it.
Right on.
Husbands, that's what she wants for Christmas, I promise.
Yeah.
Okay, so credit. If you have a home equity line of credit and there's a large balance available, you might get a call from the bank that says they're shutting it down and you don't have access to it. That's something to expect in a recession. Home equity lines of credit, they're not going to be called due, but they will stop you from using them because there is a serious unknown factor. So we know that housing is going to decrease by X, and we know that any number can be substituted for X, any number on the number line. So we are not going to rely on our equity line to get us through. If
Hmm.
you have an equity line that you took because you wanted to have a cushion, take some money out and put it aside, what you need. If that's your cushion, take some out and put it aside. And if you don't do that, then you are at risk of the bank saying, hey, we're no longer allowing you to take it. And that does depend on the equity position that you have. If the home is worth $2 million and you have a $300,000 equity line and you only have a $500,000 first mortgage, not so much of a big deal. But in many cases, they're going to shut those down and in some cases not even offer them anymore. So that's
Hmm.
the first thing about credit. Second thing is that you're probably going to see that even with creditors, right? Interest rates go up on your credit cards. So if you've been slow to pay off the balance of a credit card, then the balance is increasing. So I know like some people say, I can make the minimum payment on the credit card instead of using my savings to pay off the card. But if you just look at how that interest is compounding and how the balance is going up, then you might say to yourself, wait a minute, I'm better off paying this off, although I might not have this cushion. I'm saving myself X amount of dollars every single month. You definitely want to analyze the limits of your credit cards, and you want the utilization to be under 30% at all times. You need to be active on a couple cards, but you don't need to be active on every single card. Some people use the excuse of, oh, I'm buying this and I'm paying it off, and I'm buying this and I'm paying it off. You don't have to do that across 4 different cards, just 1 or 2. So credit is important because when you have times of crisis, and lenders across all types of loans, whether it's vehicles, personal loans, mortgages, they're going to have an increased criteria. They're going to require more equity. They're going to require higher credit scores. And if you don't have either of those things, the cost of your financing increases significantly. So something to be careful for. Hopefully
Okay.
that's a good tidbit.
Awesome. Yeah, no, that's great. That's really helpful. I think people will get a lot of value out of that. So how can people get a hold of you, Patty?
Man, that's such an awesome question. Let's see. I am all over social media at Padi Goodspeed. Padi Goodspeed is with a D. PadiGoodspeed.com. I try to keep it simple. On my website, it talks about this fabulous webinar that I'm doing once a month. Because of some of these conversations that have taken place through various modes of social media, people ask me a lot of questions. It's hard to answer them sporadically. So we have one place where we congregate once a month to go over the headlines. It's called The Truth Behind the Headlines. You can sign up for that through my website, and also on my Instagram. The link is in my bio. I make reels to try to keep people updated on the market. And of course, my strong suit, what I've done for 20 years, is approve people for mortgage financing. So if there's any needs out there for that, I'd be more than happy to serve them.
Awesome. Well, thank you so much. You've been incredibly gracious with your time. We've almost gone an hour. It does not feel that way. It's hard to believe, but it has almost been an hour. So I need to run, but I really appreciate you being a part of this today. It really means a lot, the fact that we can educate people and that I have somebody of your knowledge, expertise, and skill set to be able to come on here and talk about these things. So thank you so much.
Oh man, thank you so much.
Yeah.
I love it. Thank you.
Awesome. Well, have a great night. And thanks, everyone. We'll see you later. And Patty, just hang tight. We're just going to end the broadcast now.
Okay.
Bye.